The market has recently displayed a notable upward trend, marking 3 consecutive days of gains. This positive movement is highlighted by the Nifty index, which closed significantly higher. Such sustained increases often signal strong investor confidence and positive market sentiment. However, a deeper analysis is required to understand the underlying factors driving this rally. Examining the nature of this upward trend is crucial for assessing its sustainability and implications. Further investigation will reveal whether the gains are broad-based or concentrated in specific sectors. The market's daily structure provides insights into trading dynamics. Analysis of price charts reveals key patterns and behaviors. On a specific day, the market opened with an initial dip in price. Following this dip, prices experienced a gradual climb throughout the day. The market maintained its position near its peak value as the trading session concluded. This pattern suggests controlled accumulation rather than impulsive buying activity. Market behavior can be broadly categorized into 2 types: emotional and intentional responses. Rapid surges in market activity often indicate an emotional response from participants. These emotional reactions can lead to volatile and unpredictable market movements. Conversely, a gradual, sustained market climb suggests intentional positioning. This indicates strategic accumulation by informed entities, reflecting deliberate actions. Market breadth analyzes the number of advancing stocks versus declining stocks. It indicates the overall health and participation within a stock market. A strong market breadth occurs when many stocks are advancing. This suggests broad participation across various market segments. It signifies that the market rally is not driven by just a few stocks. Conversely, weak breadth indicates a narrow rally, often less sustainable. Strong market breadth often indicates institutions are strategically building positions. Institutions typically accumulate assets over time, rather than chasing rapidly rising prices. This strategic accumulation aligns with more controlled and sustained market movements. Their measured approach contrasts with speculative buying driven by quick price surges. Despite indicators of strength, the market currently exhibits a noticeable degree of hesitation. This suggests that positive catalysts are present, driving some market activity. However, other significant factors are simultaneously preventing an unbridled surge. This dynamic necessitates a closer examination of the underlying market forces. Understanding these dynamics is crucial to explain the current market behavior. Analysis of sector behavior reveals significant divergence in performance across various market segments. Sectors such as media, IT, realty, auto, and consumer durables are experiencing strong gains. Conversely, the fast-moving consumer goods (FMCG) sector shows flat performance. The metals sector is currently exhibiting slightly negative returns, indicating varied market trends. Market behavior indicates a selective approach to risk-taking, rather than indiscriminate investment. Varied sector performance highlights that the market is not uniformly investing across all sectors. This suggests a discerning strategy, where risk is assumed in specific, chosen areas. The market is not retreating to defensive assets, demonstrating confidence in growth opportunities. This balanced approach reflects a nuanced risk appetite within the current economic landscape. Traders often concentrate solely on overall index movements in financial markets. This narrow focus can lead to missing significant trading opportunities. Crucial capital rotation frequently occurs within specific market sectors. Understanding these underlying sector shifts is vital for informed trading decisions. A broader perspective, beyond just indices, enhances a trader's strategic advantage. Stock-level action provides clear confirmation of ongoing sector rotation in the market. This phenomenon indicates a shift in investor capital between different market sectors. Leading stock performance is predominantly observed in the financial sector. Information technology (IT) stocks are also demonstrating strong leadership. Conversely, defensive stocks are currently experiencing a period of reduced activity. This reflects a deliberate and strategic repositioning of capital by investors. Observed stock-level actions indicate intentional capital movement. Funds are systematically shifting from defensive sectors. This reallocation is directed towards growth-oriented sectors. It signifies strategic repositioning, not fear-driven selling. The India VIX is a key indicator of market volatility and investor sentiment. A drop in the India VIX generally signals a reduction in market anxiety among investors. Recent data shows a decrease in the India VIX, suggesting easing market fears. Despite this drop, the current VIX level does not yet indicate a true bull market. In a typical bull market, the VIX is observed to reside within a much lower range. Therefore, while anxiety has reduced, the market is not fully in a bullish phase. Market sentiment can be assessed by various indicators, reflecting investor mood and expectations. A lower VIX or volatility index typically indicates reduced market anxiety among participants. This state suggests that investors are less fearful but remain vigilant and cautious. It is distinct from true market calm, which implies an even lower volatility index. True calm would signify a deeper sense of security, beyond mere reduced anxiety. The Indian rupee is currently experiencing a significant depreciation against the US dollar. This currency movement places the rupee near its historical record lows. Such depreciation signals a quietly escalating pressure on the Indian economy. A weaker domestic currency directly impacts the cost of imported goods and services. This increased import cost can lead to higher domestic inflation rates. The rupee's value is a critical macro signal for economic stability and consumer purchasing power. Wholesale inflation currently stands at 2.13%, indicating an upward trend. This level is not immediately alarming but requires monitoring. Accelerated inflation can erode purchasing power for consumers and businesses. A sustained rise in wholesale inflation impacts overall economic stability. A trade deficit occurs when a country's imports exceed its exports. Recently, the trade deficit has shown a slight improvement. Despite this, it continues to be a significant economic concern. A persistent trade deficit can exert downward pressure on the national currency's value. It also signals underlying imbalances in international trade relations. The stock market often exhibits upward movement, reflecting investor optimism and confidence in future growth. Simultaneously, the broader economy may still be undergoing significant adjustments and restructuring. This creates a divergence where market performance does not fully align with underlying economic realities. Such a scenario indicates coexisting market optimism and persistent economic tensions. The U.S. Federal Reserve's decision to pause interest rate hikes has significant global implications. This action provides a period of stability, offering breathing space for international markets. Such monetary policy decisions directly influence the direction and volume of global capital flows. The Fed's stance plays a crucial role in shaping investor sentiment across worldwide economies. A pause in rate hikes can lead to increased investment in emerging markets and other asset classes. The Federal Reserve recently implemented a pause in its monetary policy adjustments. Despite this pause, major U.S. market indices did not experience a rally. The Dow, Nasdaq, and S&P 500 all recorded declines in performance. This indicates that other global factors are contributing to investor caution. Asian markets demonstrated notable strength, contrasting with trends observed in the U.S. Key indices like the Nikkei, Hang Seng, and Shanghai Composite registered gains. This performance indicates a degree of selective optimism within different global regions. The resilience of these markets highlights their distinct economic dynamics. Such regional strength suggests varied investor confidence across international economies. Crude oil prices are currently experiencing significant volatility in the global market. Prices are hovering around the $100 per barrel mark, indicating market instability. Geopolitical tensions are a primary driver of this ongoing price fluctuation. Instability in West Asia specifically contributes to heightened market uncertainty. Crucial supply routes, such as the Strait of Hormuz, are also impacted by these tensions. Disruptions or threats to these routes directly influence global oil supply and prices. Volatile oil prices are a critical external factor for India's economy. These fluctuations directly influence domestic market dynamics. One significant impact is on the country's inflation rates. Oil price volatility also affects the value of the Indian currency. Ultimately, these factors collectively impact India's overall economic stability. Recent market movements are influenced by several key factors. One significant driver is short covering, occurring as expiry dates approach. Another factor is sector rotation, with capital shifting into IT and financial sectors. The absence of fresh negative news also contributes to market sentiment. A lack of adverse news can act as a positive catalyst for market activity. Market levels are defined by key resistance and support points, crucial for technical analysis. Resistance is identified at 24,000, indicating a price ceiling where upward movement may halt. Support is established at 23,550, signifying a price floor where downward movement may reverse. An additional buffer for support is noted at 23,650, reinforcing the lower boundary. The current proximity to the resistance level suggests a tightening risk-reward ratio for traders. The current market environment is characterized as a transition phase, not inherently weak. It also does not represent a strong bull market, indicating a period of change. Momentum is observed to be building, suggesting potential for future growth. However, market conviction is still developing, requiring careful consideration. This phase necessitates a disciplined approach from traders and selective investment strategies.